bevo.com.
He's become the unofficial spokesperson for the entire private equity. He is unquestionably one of the world leaders in private equity and business. I'm delighted to welcome today Jon Moulton, Chairman of Better Capital. Welcome, Jon.
Thank you.
Jon, you've always been able to predict macroeconomic trends very well, or at least better than most, the vast majority of people.
Perhaps the last few years, yes.
Yeah, well, that's right. Well, 08 and 09, the recession, you predicted that, I think,
yeah.
on YouTube. So what's next? Maybe sort of short term and then 2 to 3 years out, do you think?
Well, first of all, I hope I'm wrong. So I'll preface it with that. But certainly for the UK, we have this ridiculous combination of massive government debt and massive continuing deficit, much worse than we had in the mid-70s when we went to the IMF. I just sit there in the knowledge that certainly as of today, none of the political parties seem to be willing to tackle those deficits, with the result that sooner or later we're going to run into a situation where people who don't live in the UK are not going to be very willing to buy UK government debt. That'll probably cause interest rates to go through the roof. That will give us a tremendous downturn in the UK. At the same time, our currency will weaken, which will give us inflation. We'll get pressure from the IMF, possibly directly, to actually cut public expenditure suddenly and hard, precipitating possibly quite a savage downturn. And I do realise that's a completely cheerless prospect. But I have to say, I think it's the most likely way ahead. I don't know whether it's a few weeks or a few months or a couple of years away. But it is very, very likely to happen. There is too much debt. We are consuming tomorrow's production, and in fact we're consuming the production of 20 years ahead now. And
do you think the downturn that may or may not happen coming up will make 2008 look like the good old times? Or, I mean, relatively, how do you think it
Well, 2008 was the good old times. Remember 2009?
That's right. It's true.
Yeah.
Maybe Q4 2008.
Yeah, that might be the right territory. I mean, it is perfectly feasible that we'll have a long period of little or no growth, and sadly it's quite plausible we'll have a repeat of 2009, depending on how suddenly and how violently it happens.
Jon, just talk about 2009. What are, I mean, almost faced economic Armageddon. Is there any lessons you think that the private equity industry should take from the experience in 2009 so that if something does happen bad in 2010, we can at least apply something?
Well, I mean, clearly there are lessons they should take from it. That is, of course, entirely different from the lessons they will take from it. Yeah. People will forget them quite quickly.
True.
The dangers of excess leverage are still very apparent. There are enormous numbers of private equity deals geared up to the armpits, and in the event of any further economic downturn, still further numbers of those will get into trouble. If interest rates rise, a lot of those companies will get into trouble even if the economy doesn't get worse. So I think the dangers of excess leverage should have been taken to heart, but they won't be. 5, 10 years forward, people won't remember.
Right. So another potentially good year for distressed debt.
Not yet. We are in a very peculiar world, remember. As interest rates are very low. Governments have forced them low with quantitative easing, essentially the creation of money. That hasn't happened before. So that's driven rates so low that actually distressed investing ceased being a very attractive activity maybe 6 months ago. Okay. And at the moment the returns available from distressed debt investing are really quite weak. Things which look to have serious credit risk in them and trading it pretty well at the level of things that don't seem to have any risk in them. But I do think there will be another belt of distressed investing when interest rates rise, when defaults rise again, which they almost certainly will.
So with your economic forecast, is there anywhere there's going to be big opportunities for your colleagues in private equity? Is there anywhere that we can chuck the pessimism out the window and start making some good returns, do you think?
There are certainly places you'll make money. There always are, even in the bleakest of days. So there was probably somebody who made a good living out of the scrap at Dunkirk. The reality is that the only place that's obviously going to make money is going to be rescue, turnaround, distressed investing, somewhere in that area.
Jon, you haven't got as far as you have without having a very strong investment philosophy, but coming out of 2009, has even the great Jon Moulton learned a thing or two, and has your investment philosophy changed at all after the last 12, 18 months?
Really hasn't. I actually, I have to say, I enjoy difficult times. I've done much better investing in troubled times, in companies where fear dominates the valuation in the future rather than greed. So I really didn't change very much last year. I actually became much more convinced that my time had come. And we'll see if I'm right in 3 or 4 years.
Jon, talk about the future of private equity for a second. Is there 2 or 3 major sort of or strong trends you think that are taking place now within PE?
The strong trends differ a bit by where you are in the world. And clearly the emerging markets have got very different dynamics for venture capital and expansion capital than the relatively declining Western world. In the developed venture capital markets, private equity markets, US, Europe, I think there's every reason to believe that the industry will shrink a little. There's a very great deal of money still in the industry. Unspent cash approximates that at the spring of 2007. So there's still a lot to spend, and it's going to be hard to spend because there's no leverage available. But it will be spent. And that means that on average, with no leverage, the returns will be a bit duller. They'll come down to something resembling the rate of return on assets in companies. That'll mean a lower return from the industry. Lower return will mean less money coming into the industry. And slowly, and it will be slowly because of the way that the industry is structured, the industry will shrink somewhat. I don't think it'll shrink fantastically, but I do think it'll shrink a bit.
So where do you think it will look like maybe for the mid-market? Where do you think it will be in 2 to 3 years' time? Do you think it will be all under better capital? Or?
I think no, it won't be all under better capital, sadly. The mid-market's going to be less affected than the big market. Don't forget, the big market is the bulk of the industry. The mega funds so dominate the weight of money that changes in the mid-market are really irrelevant compared to the loss of a couple of KKRs and a Carlyle fund or something.
Sure, yeah. Jon, you mentioned there emerging market, and emerging market private equity, there's obviously a lot of buzz around. Is that unfounded speculation there, or is there a real immediate opportunity?
Well, it's not unfounded speculation, it's definitely speculation. Emerging markets still, on the whole, are reasonably volatile places. There's risk, but there's tremendous reward available too. The economy is growing at 5, 7, 10%. Forgive lots and lots of errors. If you invest into those economies in roughly the right sectors, you can make a fortune, and some people will.
Yeah. And do you, Jon, is your investment philosophy more around geographical opportunity or industry sectors?
I'm just really rather dull. Brought up in the UK. I tend to be more focused here than anywhere. I have got investments elsewhere. Yeah. But I'm too old and too dyed in the wool, really, to get off and launch an Indonesian venture fund. Yeah. Which might be a far more attractive activity than doing it in the mid-market here.
Oh, I think you're doing very well here, sir. So I've got a friend of mine in private equity. I've quite a few, actually. Some of them think it's going to be the good times coming up. Other people are thinking, you know, this is the good times in private equity are past, and now the power will have shifted to the LPs, and is likely now to see sort of, you know, fees being curtailed and carry hurdles raised. What's your thoughts there?
I don't think there'll be much happens on the fees and carry. There ought to be, but investors seem really quite unmoved by the fact that people can get very rich out of fees. Is it going to be a less attractive industry than it was? Yes. It's far more crowded. Being one of 20 private equity firms bidding for the same company is a desperately dull activity. You can pass years as a worker in one of the large firms and never do a deal. It is dull. Returns are definitely lower than they were because of the intensity of competition, because of the absence of leverage. There's another big moving part, which is what happens to the economies you're in. Good economies, returns will be better. Weak economies, returns will be worse. Weak economies will also mean failures will be more numerous.
So if you're one of those 20 private equity companies bidding, how do you stand out from the crowd and from the GPs, and how do you create a real meaningful competitive advantage to win more often than not?
Oh, it's quite easy to win auctions. All you have to do is bid more than anybody else. You have to see attributes that nobody else can spot. And occasionally that's actually something you can do cleverly. Most of the time it isn't. But if you can see a different way to run a business, a different strategy for a business, you can justify a different price perhaps. But actually it is very hard. It is commodity in nature. People are given the same information, the same financing environment, differences in view. Being the top bidder of 20 probably means on average you're the one with a stupidly optimistic case.
And in terms of spotting sweet spots in value creation in a target company, like you just referred to, any advice on ways to do that?
Nothing really beats experience of something similar. The next best is the application of lots of wit and hard work. But it is hard to apply the wit and hard work to a company that's being sold in a controlled auction, because you may never be able to get your hands around the information you need to complete the analysis. And
hard work is one of the things that you mentioned last time in our last interview, was one of the characteristics that really sort of gets you to the top of your industry. Any other personal characteristics that you're most proud of, sir, that makes you continuously get to the front?
Proud of is the wrong word, but I am insensitive. That means that I take my losses without very much grief. I continue to sleep, and that enables me to continue to work. That is actually quite a useful asset over a long period. And the other thing I'm really pleased with is my own curiosity. I am attracted to looking at odd things, things that intrigue me, things that need fresh logical analysis. It's really good for me. I enjoy it immensely.
Jon, talking about lending, it's not exactly boom time out there for the banks lending money at the moment, as you know. So do you think that debt has had its day? Do you think we'll ever get back to the 05, 06 levels? Or?
Oh, we'll get back sooner or later, don't worry about that. The question is whether it's 5 years, 10 years or 20 years. It's probably not longer than that. Okay. The UK seems to be quite good at having lending excesses about every 15 to 20 years.
So, but do you think that in some ways that the lack of debt out there now has forced companies or private equity companies to really create, to focus on value creation? So do you think in some ways it's made the private equity industry stronger?
We'll find out. The industry was making a lot of money out of leverage and increasing pricings. Yes. That's what drove it, in good economies up till 2007. Yeah. Now the leverage is gone. The increasing multiples might or might not occur again. Nobody knows. Depends on interest rates, depends on the global economies. Yeah. So the private equity boys were really left with little else to do but to try and work companies harder, to try and become more industrialists. Of course, they used to be called conglomerates, things that did that. And private equity firms do bear a very sporting resemblance to them.
Increasingly so. And so leveraged buyouts are out the window?
No, not out. They're just diminished. Okay. There'll be less of them. There'll be less of the ludicrous excesses that occurred in 2007.
Jon, 2009, as you know, fundraising was tough for a lot of people in the private equity industry. 2009 numbers significantly down. Jon Moulton fundraised pretty well. I think you were quite atypical in the space. And it may have been the Jon Moulton brand as one of the benefits of having the brand that you have. But any advice for GPs out there now looking to fundraise?
Well, I would obviously prefer them not, because I really don't need any more competition.
True.
There is no really very good advice. It's, again, back to the old hard work. There are few interested investors, a lot less than there were. To attract their attention means that you have to show you are very good. That's difficult. And it would appear, as much as 18 months to get together a fund for a quite reasonable group at the moment.
Jon, with the multiples of EBITDA now not as common, the great multiples of EBITDA not as common, with lack of leverage out there in the marketplace, we talked about value creation. But in terms of really improving a company through operational improvement, what 2 or 3 things do you have in terms of way of advice for people that are really wanting to really focus on operational improvement now?
It's boring, I'm afraid. It's about analysing things thoroughly, looking for the weaknesses. My own firm specialises in turnaround.
Yeah.
There we're looking for big, dramatic ways to cut cost, eliminate losses.
Yeah.
We can add a lot to the EBITDA from a negative position quite often by taking big steps very quickly.
Yeah.
But if you're buying a mature business that's making a reasonable profit, then to find the rest of that value add probably involves you in focusing on every aspect of the business. The people, the financing, the logistics, the location, the taxation. You just simply have to do the lot. There's no shortcut.
How much time would you say you spend on value creation and operational improvement yourselves?
It depends. I've had periods in my career where I've spent 100% of my time doing that, when I've gone in to run a turnaround, for example. And there are periods when, frankly, I probably spend 5% of my time doing that, because I'm fundraising or hiring staff or deal doing rather than worrying about maximising the value of the companies.
Right, yeah. And if you've got a good management team, then
if you've got a good management team in the company, or you've got good managers in your own operation, you of course can do less. If you've got an excellent management team, the worst thing you can do is meddle.
Yep.
Let them get on with it. Sit back and applaud. Much the preferred situation in private equity.
Absolutely. Jon, given the pulling of the New Look IPO, it seemed to me that it may be because they didn't want to be lining the pockets of the private equity guys with the proceeds. But would you do you think that the public markets are now closed to private equity exits for the foreseeable future?
No. I mean, closed for a short period, probably. The public markets have very short memories and very short cycles. Having said that, large private equity IPO exits have given so much grief to some of the institutions that I think they're going to be quite hard to do over the foreseeable future. You may be able to IPO them, but you won't be able to dump most of your shares in the hands of other institutions. They've been bitten by a couple of them very badly.
Jon, if we can talk about Better Capital now. In your letter to investors at Alchemy, you mentioned I would do it again, but better. Was that, by the way, a clue that you're going to come out with the name Better Capital, or?
Well, actually, not. I didn't think I'd get the name Better Capital for a start, and I only got it because the company that had it conveniently went into bankruptcy in the summer. Okay. And I got the name the day it became free in October. But it is a very good name, actually. Yeah. Easily remembered, conveys a nice image. It's worked very well.
So, what about the things that you are using the name? What about the things that you're intending to do better compared with some of your not just Alchemy, but in the past? Is there any?
Well, Better Capital is doing nothing but turnarounds. Sure. Yeah. So the first thing we're doing better is getting the companies to run better. That very often means changing management. It doesn't always mean changing management, but mostly. The companies are in trouble because something has happened. Most of the time that's the fault of management. Sometimes it's the economy. Often it's both. Sometimes it might just be that they've walked into a horrible pension problem, a horrible litigation. So it's turning the company around, making it better, giving it a better outcome. In the current environment, a lot of the time, it also means giving it a better capital structure. So Better Capital really works well to describe that. Over-levered companies are extremely numerous. Poor performance plus over-leverage equals absolute disaster, and that's when we arrive. So we sort out the balance sheet, sort out the operations, sort out management and strategy, and move the company forward. In some ways, it's a lot harder than regular private equity. In some ways, it's easier. To take a company from an appalling state to a decent state is, in some cases, a lot easier than taking it from decent to excellent. So and really it can be very simple. It can just be, okay, we'll stop trying to sell this product.
Right.
Which is not actually that big a decision when you look at it from outside. It can be when you're inside a company.
Yeah. And something that like that, where it's so obvious as a possible target company, is it got to be really obvious to you like that to then?
For us to want to do a turnaround, we need to see a few actions that are within our control substantially, that take the company from loss to profit.
Yeah.
That's the guts of doing a turnaround.
Yeah.
Virtually everything I've ever worked on in this area has turned into profit in the first year. You can, of course, turn around things that have got lots and lots of problems. But that's for people who like to work even harder than I do.
And Jon, Better Capital, it is a great name, and you're focused pretty much exclusively on turnaround, is that right? Okay. And the thoughts, the logic or philosophy behind that?
Well, coming out of a really pretty deep recession with the prospect of another one, with massive amounts of debt in the system, there are no shortage of turnaround opportunities. And when interest rates rise, I suspect we will need a much larger waiting area at the office.
Jon, you're famously known for back at Alchemy giving, in terms of corporate governance, giving your partners quite a lot of power, actually. Would you do that again? We're just interested in if you would do the same type of corporate governance structure again, where your partners have a lot of power.
This is probably my last company. I fear the wife will kill me if old age doesn't stop me working if I do it for any great length of time. So I've actually I've taken a somewhat different structure than I have historically. This is more my company than previous setups. Yeah. And I'm quite pleased to operate that way. I've given out economics relatively generously to my partners. Okay. And I may well give the power away, but not this week.
Talking about strategy, you mentioned, we mentioned the word strategy quite a few times, but how do you feel a strategy should be done within any business unit or organisation? Should it be by committee or one individual at the top that ultimately makes the decision, do you think?
The answer is, of course, both. Right. It's really pretty hard for a single person to make a decision and carry it through without the other people being convinced to follow it. Yeah. And that's even true of things like sort of Stalinist Russia or Hitler's Germany. They were rather dominated by one soul, but they were able to carry a very large amount of opinion with them. Yeah. So even if you're an extremely aggressive leader, you still need to bring people along. Yeah. The danger of arriving at corporate strategy by decision is that you will typically be too moderate. There will be too many vested interests present. Yeah. The danger of one person is, of course, they just get it bloody wrong. So there's no totally right answer, but I must admit I prefer to see a clear CEO in a company, and I prefer to see a clear leader in any business.
Jon, last time when we talked about CEOs and sort of what makes for a great manager, you warned us very well about the difference between a great presenter and a bad manager, and that was
the reason I'm smiling is I actually had a great presenter, lousy manager combination in the office this morning.
Oh really?
Yeah. Yes, the moment we moved off the PowerPoint, he'd had it.
That's right. So I think in the last interview you say you just have to probe a few inches deeper than normal, and then everything crumbles. Is that right?
It does indeed.
That's what happened. The poor guy or lady that happened to, I feel sorry for them actually. I have a little bit of sympathy. So talking about the CEOs, I mean, you've obviously you have to identify great management teams. So what do you look for in a great CEO?
As rounded a skill base as I can get. In the turnaround world, I look for something different, though, than the generality of private equity. In the turnaround world, you don't need slow, considered human beings. You'd prefer to see people who take a lot of action, excessive, if anything, bias towards doing things. Right. So you want somebody who's possibly quite turbulent, probably not too fussed about being loved by the people around him. And he may be completely unsuited to running the business 18 months later, when it gets down to how do we hold this thing together in detail, make small incremental change. But we're looking for people who are intelligent, analytical, decisive, confident, They've got to be able to carry people with them, but they're going to be able to pull them along in a way you don't in a stable, well-run business.
Yeah.
So different sort of characteristics.
Yeah.
We need them to take actions. 100% actions taken and 85% of them right in turnaround is really what you want, not the we've done 50% of the actions and we got them 100% right.
And moving away from sort of a turnaround CEO as a sort of CEO of a company that's nurturing, what would you say? A lot of those attributes still applicable, or is there
a lot of the decisiveness can be a notch or two down.
Okay.
The ability to pull a team along with you becomes more important as companies become stable. Those are the real changes. I always find it incredibly hard to pick the good from the excellent.
Yeah.
You only find that out some months into a relationship with a CEO.
Yeah.
It's one of the reasons I do turnaround, because spotting bad is much easier. They don't know the numbers, they don't visit the sites, they haven't met their customers. They're very easy to spot.
Yeah.
But the guy who does a reasonable job as opposed to an excellent job, that's often very hard to pick apart quickly.
Yeah, the grey is always harder to see sometimes, isn't it?
Indeed.
Yeah. So, John, what would you say is the best piece of business? There's two things I want to ask you now. Sort of, what's the best piece of business advice? And you yourself are a leader with a great following, not just in your own company, but out there in the marketplace as well. So you've created willing followers. From the business perspective, first of all, is there any great piece of business advice that you've received in your time so far?
There's no single nugget that dominates my days.
No.
I wish there was. It'd be a lot easier to remember that all the multitude of things you do need to do.
That's right. Just one mantra would be great.
I suppose if I had one thing that I would say to anybody who doesn't follow the numbers in their business, it always fails.
Yeah. Yeah.
That's about the one really sort of certain piece of advice. You can put it in a slightly more humorous way by saying I've never had a company fail through having too good financial control. And I have rather a lot of experience to the contrary.
That is a good piece of business advice. On leadership, John, you've got a lot of those attributes you mentioned, but any piece of leadership advice or anything that stands out?
I think little more than you have to set objectives in this life, and winning isn't necessarily the objective. For most human beings, it's about being happy with themselves. So if leading makes them happy, they should do it. But if it doesn't, they shouldn't. So the idea that you can give people that will convert them into good leaders, I think is often wrong. People tend to be born or developed into leaders, and they have to be happy being leaders. Many people are happy followers.
And you mentioned as well, I think that in the last interview you said that you've got one of the benefits of loving what you do is that the working hard comes naturally because you're loving what you do. You love to lead.
I have absolutely no difficulty in knocking out 15 hours in a day when I'm enjoying myself, which is most days.
It's a fantastic position to be in. What are some of the days that you don't enjoy so much? Is there any?
I've limited tolerance for lengthy exposure to bureaucrats. People with unclear objectives. I tire of journalists after the first hour, typically. Better
be finishing right now.
Seriously, the things I don't enjoy are the more tedious and pointless. I have absolutely no tolerance for a pointless meeting.
No.
I'm out in 5 minutes.
Yeah. But the good presenter, bad managers, that's another one up there.
Well, they can actually be quite enjoyable because, of course, as you puncture balloons, they do tend to go pop, and that can be amusing to watch.
Next time you've got one, can you invite me around? I'd love to see that. Last question, John. You've got some fantastic people already working for you at Better Capital. What advice do you have on just getting a brilliant team together working for you?
I'm not a very systematic hirer of people. I typically hire people I like, get on with. I normally form a view on somebody within 20 minutes. This can, of course, be a gross error. But if I don't like them in 20 minutes, I never hire them and never go forward with them. I admire people who are going to try hard. I admire people who push their own capabilities to the limit. I've no time for dishonesty. I've enormous time for people who are honest triers, even if they don't prosper. And I will endeavour to keep those kind of people in my organisation doing something that's appropriate to their skill base. How do I select the very best? The best are when I take wild hiring decisions. And a reasonable proportion of them work out.
Really?
I've worked with some excellent people over the years, and some of those would not have fitted any reasonable HR department's view of what I should have hired.
Interesting. So the checkbox behavioural competency thing goes out the window to some extent.
If you want to get the best, it probably does go out the window.
Yeah.
Most really good people are actually quite unbalanced.
Jon, as always, absolute honour and pleasure to have you with us today. I just want to say thank you so very much indeed.
And thank you.